Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 16th day of May, 2014, and this is the daily report for gold and silver, our weekend review, and what a lackluster week we have seen. In essence, when we pull up a weekly chart, you will see that we have slightly lower pricing. Today we have lower pricing, off about $3-4. It's been trading in that very, very narrow range, and we are quickly approaching the apex of this triangle. If that will really evolve into any fruit, in other words, if we'll see a breakout, is something to be determined later, obviously next week. But for now, we're looking at, as I said, off about $3. Now the high is $12.9950, the low $87.30 on the day. Current print 93 and change, 92 and change. As I said, off about $3. Silver trading lower on the day nominally, though, about off 10 cents on the day. You can see current print is 35.36, 1935.36, the low 19.16, the high 19.61. More on silver towards the end of the show. Now, really, what I mean by a lackluster week is the open compared to the close. We're looking at a weekly chart right now. This is the week that was Friday. You can see that it's green, meaning that it closed higher than it opened, but very, very slightly. This candle would be identified easily as a doji because the open and close are so close together. But when we consider the last, call it, month in trading, this is the last 4 weeks right in here, you can see that the predominant characteristics over these last 4 weeks has been that narrow open to close relationship. In terms of highs and lows, we've had some extreme lows, around, call it 70 to 75 in that area. And in terms of the highs that we had really was 1312 right here. And then I believe here we had about 1302. So we've had, really in terms of a range itself, about a $30 range. Now, to me, we are at a fairly critical area, this 95, and you can see that by these two lines. This particular chart that we're looking at is a weekly chart in which I have a numerous amount of different Elliott wave retracements. You can see now that I've compressed it, we were looking right here at this area. And typically what I look for, as we talked about yesterday, our weekly viewers, just as a refresher, we look at this as what's called harmonics. And harmonics are the fact that I'm starting at different points to the top. This is one fib retracement here. This is another one here. And you can see that what we're basically doing is pegging these different bottoms. And then going to the top to get our different fib retracements. And so what we look for is critical areas, and we define the critical areas as points in which you have two different retracement cycles really pointing out the same area. So here we have 92 on the low end to 95, 96, markets trading at 93. This is a pretty critical level. We really need to see that hold, because if it doesn't hold, the next real level has got to be this level right in here, this next level right here. We'll talk about that in a second. But the fact that we're trading right at that area and have been roughly for the last 6 weeks is telling us that this market is either forming a base to move higher, or it could be forming a base to move lower. And the reason I say that is the compression triangle that we have been looking at. And this is the triangle that I speak of. Now, this is a short-term study, 480-minute chart, and I've simply put in an upper-level resistance line. I've also put in a lower-level support line. And any way we look at it, we are getting very, very close to the apex. Now, earlier this week, according to my calculations, we actually did trade above that. That's right in here. But the market moved right back into the zone and is currently, as you can see, not outside, but right near the apex of this line. And let me go ahead and blow that up just a little bit so you can see what we're looking at. And if you notice, we've had a bunch of different lows that have come into this area and really broken below there. But what to me, this of course is a Japanese average chart, but what to me is really, really important, of course, is the fact where the real bodies end up. Now, traders, what I've done is I have converted our Japanese average. Now, realize a Japanese average will filter out a lot of the noise. And so I've converted it back into a standard candlestick chart. And when I do that, let's blow this up a little bit. You'll see that this has been sloppy at best. We're not really seeing the true type of action that I would like to see just prior to a breakout. Here you can see the market moving up and over and then back in. Here you can actually see it moving below the line and is now moving back into this compression triangle. And so my sense is on this compression triangle that we certainly might not see any kind of a severe breakout either to the upside or downside as we typically can, because what we're seeing more than anything else really is sideways trading activity, a very, very narrow range defining the most recent activity of the market. We'll pull up a daily really to illustrate that better. And this is just the activity I'm talking about. We're looking at a daily chart. You can see this is a slightly lower close today, but if you look at the relative body sizes of many of these trading days, these candles, in fact, most recently right here, you have these double dojis. Here you have a doji. You get a couple of these right in here. Predominantly what we've seen is as the market came down, we did have really good support, call it 1281, right in that area. Market comes up and hits absolute resistance, roughly between 28 and 33. Came down, we had these extreme lows right in here, but if you look at the bodies of the candles, meaning the relationship to the open and close is a standard candlestick chart, you'll see that the majority, the vast majority of them closed above this point, even on lower closing days. So that what we witnessed was first this high right here. This high, as I said, came in roughly at 30, 28 to 30. Our secondary high here, this was just below 1300, this being just above 1300. I believe 1302 to 1305 was a high somewhere in here. And these last sets of highs have been just under 1300 again. So we almost had, if you notice, you have a high here and then two lower highs, almost kind of like a head and shoulders. On a daily chart, of course, this is not a head and shoulders, but what we're looking at is the fact that we've had a higher high in the center followed and also behind it having lower highs in the marketplace and having a fairly stable level of support. And that is really indicative of a market that's trading in a defined range and a narrow range. And we've absolutely seen this for the better part of April and through May. So almost the last month in trading, we've had this very narrow sideways market. And the sideways market, of course, is a difficult market for any trend trader to profit from. But more importantly, to get overall direction or upcoming direction has been a difficult read also. But this is what we're looking at currently, a market trading in a defined and narrow range. Now, one thing is evident. We're looking at a two-day chart. I've got an Elliott wave count in here, but that's not what I want to focus on this particular chart. Rather, what I want to focus on is the fact that when we see the market kind of bunch together, this sideways trading range, as it either forms a base, when we look historically in the past for areas in which the market kind of compressed and bundled up together, you can see that right in here, the market really genuinely compresses, trades sideways for a while. You can see that here. You can see that a little bit right here also, although there's a little bit more of a range, but you can definitely see that right in here. What we are saying is that when this market compresses and trades sideways for a while, you can especially see that here. What we have found on some of these occasions is the fact that kind of like a spring, what we're seeing is the market really winding up. And that would fit with the idea that we have some sort of a compression triangle going on, because just prior to these kind of substantial breakouts here to the upside, here to the upside, here to the upside, and here to the upside, it was just following a point in time when you really saw the market kind of compress and it would trade in a much more defined narrow range, because as the market's taking off, we have this nice cluster of the market or nice expression of the market moving up, and then it tends to kind of cluster or move sideways for a while just prior and then spike up or down. So my sense is that it is a time period that we absolutely want to be aware of. We could be on the verge of a major break to the upside. However, when it's trading sideways, it's really difficult to state that. But if we look historically at the marketplace itself and see what's happened on other occasions when it's kind of bunched together very, very tightly, it seems as though that occurrence does happen just prior to a nice spike in the market. And so we'll have to see if that, in fact, is what we will see in the upcoming week or 2 weeks ahead of. Now, this is yet another expression of a 2-day chart, standard candlestick format. And what we can see is we've been using this chart with our Elliott wave, our Andrews pitchfork. We have our handle here, our outer zero prong here. Here we have our 100. The whole idea behind this chart is as long as it's staying within the bounds of this Andrews pitchfork, what we're seeing is any kind of trend that we see to the upside is simply put a counter trend to the overall direction of the market, which has been down. In other words, you've got a bearish market with bullish counter trend waves coming into it. The only way we can technically say that we're out of the muck, so to speak, in that bearish sentiment is to break above these cascading channel lines. We did that once, but it was one where there was zero follow through, and in fact, all it really did was touch upon that, come back down, and it found genuine support at the 23% level. Now, it spiked off of that point, and this is that 1330 right here. These are the 1312s, 1302s that we've talked about. You can literally see how it's just been moving sideways. So my question is, will we get some kind of bunch and then a spike above this? Because that's what we need to see to be able to say with any kind of certainty that we are not experiencing bullish rallies that are anything more than counter trends without breaking above this particular crossroads right in here. Without doing that, we have no technical evidence that tells us anything on these bullish rallies other than what we have seen have been counter trends to an overall bearish trend. So one of the real questions to me is, has any of this recent activity caused any long-term chart damage? And the answer to that has got to be no. At this point, we still have our double bottom intact just below $1,200. I believe that there's a distinct possibility that this move down from 1900 all the way down to this double bottom here at about 1180 roughly would in essence probably have concluded this dramatic sell-off. However, we had this one spike here. This took us, I believe, to 1430, somewhere there. And then as this market's come down, what we really need to see is some sort of recovery. And on this particular chart, we're going to be able to ascertain any kind of bullish sentiment if in fact the market moves above 1400 on a long-term basis. Right now, we have to see the market move back above 1300. Our next real resistance point, should the market move in the upward direction after 13, is 1312. From there, 1330. Those are the areas we need to look at in terms of straightforward resistance in the market. Support, I'm pegging at approximately 1275 to 1280. So what about silver? As you know, I have been recommending that we kind of stay clear of silver. We've got this market, if you think that gold's been in a narrow defined range, take a look at silver. On the low end, we're looking at just at around $19 per ounce. The high end just below $20 per ounce. You've got this dollar trading range here. Then we go back a couple of months, and you've got a range that starts at about $19.50 and ends at $20.40, $20.35. So you've had this market really define itself within a dollar range for the better part of 2 to 3 months. My sense is unless we see some sort of really spike off of this basic narrow trading range, it has been really locked within this narrowly defined range, and we're standing on the sidelines as far as silver goes. Maintain our current long position in gold, sideline on silver. We will talk to you on Monday. This has been Gary Wagner, wishing you as always good trading. Have a great weekend, and we'll speak to you again on Monday for another daily update and review. Bye-bye.